Our wonderful pilots are above Tehran. Tehran is burning.
Without a doubt, the scope of the devastating response by the brave Iranian fighters will encompass all areas of the occupied lands.
It's time for a deal, and we'll see what happens, but sometimes they have to fight it out.
Israel and Iran continue to strike each other, and President Trump says they may just have to fight it out. But an escalated and prolonged conflict could have major ramifications for the region and the rest of the world. Live from Singapore, this is Insight with me, Haslinda Amin. Oil and gas prices rise again as Israel and Iran continue their attacks on each other, with the market bracing for any disruption in supply. We speak to widely followed energy expert Fereidun Fesharaki about how the latest conflict in the Middle East is being factored into his price predictions. China's domestic consumption jumps in May, offering a surprise confidence boost to Beijing as it stares down the U.S. in a trade spat. We'll speak exclusively with BNY's head of international, Hani Kablawi, about how geopolitical and trade tensions are affecting the outlook for deals and investment. Loud explosions over Tel Aviv after Iran's latest missile barrage on Monday morning. The open hostilities between Israel and Iran have entered a fourth day with no sign of easing. Iran has fired several waves of drones and missiles over the last 24 hours, while Israel hit the Islamic Republic's capital, Tehran, killing another key military official. Iran says at least 224 people have been killed since Friday, and Israel says Iranian attacks have left 14 people dead and around 400 injured. President Trump, for his part, says a deal to end the conflict is possible.
Mr. President, can you give us a sense of what you're doing to try to de-escalate the situation between Iran and Israel?
Well, I hope there's going to be a deal. I think it's time for a deal, and we'll see what happens. But sometimes they have to fight it out, but we're going to see what happens. I think there's a good chance there'll be a deal.
For more, let's bring in Horizon's Middle East and Africa anchor Jumana Basachi in Dubai. Jumana, open hostilities with no sign of easing. The question is whether we will see an all-out war.
Well, you could also argue that we're already in the very midst of an all-out war between Iran and Israel. Nothing like this has happened in recent history, Haslinda, and these strikes continue, the counter-strikes continue. We're heading into a fourth day of attacks, both from Iran into Israel and Israel into Iran. Israel, for their part, continued to strike military sites, key defense sites within Iran, alongside some of those nuclear sites that we spoke about on Friday, although at this point, it appears as though the actual damage on the main uranium enrichment center in Faro seems to be limited. Cannot say the same for other centers. But in terms of civilian casualties, Iranian civilians, the numbers of Iranian civilians that have been killed has now breached 224 per the Iranian Health Ministry. And on the Israeli side, most of the drones and missiles that were fired towards central and northern Israel have been intercepted, though the few that managed to penetrate Israel's air defense system have caused damage to some buildings, some key infrastructure, and there the total death toll is around 13 people per the latest. And what I should say is we've also seen a broadening out of the scope in terms of targets. There have been certain energy infrastructure sites also targeted by Israel over the weekend. The South Pars gas field, there was a fire that broke out there. Significant, of course, because it does show also a room for energy to be brought into the fold. And then in response to that, Iran also then went on to hit refineries in Haifa. So what we saw is a reaction as well in the energy space. And taking it one step further, other reports over the weekend suggested that Israel did have the opportunity to go after the supreme leader himself, Ali Khamenei, but reports suggest that U.S. officials and indeed President Trump himself did not give them the green light to go ahead. So we are moving on from a stage of tit for tat counterattacks and attacks towards possible regime change as well within Iran. And really, Haslinda, no signs of de-escalation. Also important to note that those 6th round of U.S.-Iran nuclear discussion talks that were supposed to take place on Sunday were cancelled.
No sign of de-escalation. How are the countries in the Middle East reacting to this conflict? We know that most do not want an Iran with, nuclear capabilities.
Well, you have to think about it from the perspective of security. So obviously, many countries in the region are in a heightened sense of security, closing their airspace. Many of the flights into and out of Tel Aviv, into and out of Iran, even over Syria and Lebanon, have also been cancelled or postponed. So yes, everyone's watching very closely to see what happens. And you also have to bear in mind that this Strait of Hormuz, the distance that separates the tip of the UAE, Oman to the Iranian border is something about 50 kilometers wide. So geographically very close as well. So if there is disruption to the Strait of Hormuz or along the Persian Gulf, then that's going to have knock-on effects to the region. But one thing that I would say is since 2019, a lot of efforts have been made to restore and resume diplomatic ties between the likes of Saudi Arabia and Iran. There was that deal that was brokered by China back in March of 2023. And since then, the relationship between Saudi Arabia and Iran, you could say, is somewhat better. And there have been many reports of the weekend suggesting that if Iran wanted to go one step further in terms of their response, they could target GCC infrastructure. They could even go so far as targeting U.S. assets as well. So far, they have restrained from doing that. And you could say it is reflection of some of the diplomatic progress that has been made between these GCC states and Iran. And you may recall also that on Friday, one of the first pieces of press releases that came out on that morning came from the Saudi Foreign Ministry and the UAE condemning the attacks on Iran. So it is a different situation from how we were back in 2019. But what we do know is the likes of Qatar, who were playing a key role in terms of those US and Iran nuclear deal discussions, are also coming back into the fold now to try to sort out some diplomatic resolution and also to make sure that US are actively engaged in diplomacy as opposed to getting dragged into the war as well.
Jumana, great insights. Our Horizons Middle East and Africa anchor Jumana Basachi in Dubai. Meanwhile, investors remain jittery as the Israel-Iran conflict rages on. Avril Hung has more on the moves in oil prices, and we're seeing a lot of volatility in prices, Avril.
Yeah, and we are seeing how Brent paired earlier gains. Also, it struggled to breach the Friday intraday high of 78.50, which suggests to markets that maybe investors are a bit skeptical the extent in which the conflict will lead to major supply disruption. I mean, you think about how similar standoffs in the past eventually de-escalated, and yes, Iran's energy infrastructure was targeted, but not quite its export facilities. And as to those concerns about the Strait of Hormuz being cut off and choked off, some see this as not likely, given how severe the consequences would be. And keep in mind as well, we have the presence of the U.S. Fifth Fleet in Bahrain, so some see it as extremely difficult for the strait to be cut off for extended periods of time. Now, flip the board. I just wanted to show you as well how Brent is now green for the year, but it's still a little bit away from the highs of last year and the $80 a barrel handle, which is now turning into a key level for momentum players to watch. Consider the positioning as well. The most recently available CFTC data shows us that hedge funds increased their net long positions prior to Israel's attack, and this also suggests that it might be a bit difficult for crude to rally further, given how profit taking could kick in as we approach the $80 handle. Keep in mind as well that OPEC's monthly oil report is due later today, and then it could sort of be a reminder for some that yes, recently they have rapidly hiked supply, but they still have spare capacity. They can reactivate that, and that could help to fend off some of these supply disruptions that markets are worried about, Has.
That's right. It's about demand and supply. It's also about where the conflict goes from here. Avril Hung, thank you so much for that. Let's get perspective from Fereidun Fesharaki, Chairman Emeritus at International Energy Consultancy FGE. Fereidun, good to have you with us. If history is anything to go by, then chances are the escalated prices will not stick. I mean, we didn't see prices sticking at elevated levels even after the Ukraine war.
We need to think about the oil market in two stages. Stage one is today, where things have not escalated, really. The Iranians at the highest level, they don't talk about closing the Straits of Hormuz. We have some junior people talk about it. The Israelis have not hit export facilities. All the Iranian oil exports continue as is, and Iran gets paid as before. No attacks on the power plants, no attacks on the refineries. Two minor attacks, as your reporter said, on the gas field, more as a reminder that if the Israelis want to attack, they can. But so far, there is an $8 to $10 a barrel war premium in the price. And it is all because of fear, not fundamentals. Fundamentals have not entered the market yet, and they might. If any of these things which I mentioned happen, the prices could easily go much, much higher. But at the moment, things are actually not so escalated.
So right now, what's being priced into the prices right now is just pretty much short-term supply concerns. Is that a fair assessment?
Well, yes, I think it is correct, but it is really the fear of things getting worse. And, Israelis have shown some restraint in not attacking the Kark Island and not stopping the Iranian oil exports, which is the main funds coming into the country. They continue, the Iran still gets paid. They have not tried to paralyze the domestic energy structure. No attack on power plants, no attack on the refineries, no attack on petrochemical plants, no attack on the gas fields. So really, it is still restrained. It can get worse as time goes by. If things don't come to a resolution, and I don't think they will come to a resolution, things can get potentially worse. And if Strait of Hormuz are closed, even if for 2 or 3 weeks, the prices easily can hit $100 a barrel.
The thing is, Iran holds about 9% of global oil reserves. It exports about 1.5 to 2 billion barrels. I'm just wondering, how significant a player is it? Because the most important customer for Iran is actually China.
That's correct. If the Iranians tomorrow decided to self-impose a sanction, we don't want to export any more oil, there'll be no problem. I think between Saudi Arabia, UAE, Kuwait, they'll make up the difference. So it is not a supply issue. It's the fear of escalation to the point where there will be a big war. And that really happens if the U.S. gets involved. So far, no attack on the U.S. troops, no threatening of the U.S. as such. There is lots of war of words, but if the U.S. gets involved, then it escalates in a big way. And that is, I think, the fear of the market. That's why we have the worry is that things can get worse.
The big concern in the market is whether the Strait of Hormuz will be shut. That is a choke point for the global oil supply chain. How are you assessing the probability of that happening? What's the probability of Iran actually shutting off the Strait of Hormuz?
Well, I think, remember that, of course, the Iranians import a lot of goods through the Strait of Hormuz themselves that they need. It is not just a one-way street for going out. But at the moment, without the U.S. involvement in the war, the Iranians, they have lots of supporting words from the neighboring GCC countries that they condemn Israel. The U.S. says, I'm not involved. They have no incentive to do it, because once they do that, then you escalate it, you bring the U.S. to the war, and you may really escalate it. So they don't want to take the first step, which would make the situation much more worse. So the issue really is, as far as the Straits of Hormuz are concerned, you may be able to close it for 2-3 weeks, but they will reopen it. But they will reopen it with severe attacks on Iran. And this is what the Iranians, they don't want. They don't want an escalation of bringing the U.S. directly into the war.
Right. So the shutting down of the Strait of Hormuz carries systemic risk. How much might oil prices rise? Should we see that, even if it is for a couple of weeks? Because when Russia attacked Ukraine, we saw oil prices go to $120 a barrel.
I think if the Strait of Hormuz threat is serious, if there are attacks on Iran's export facilities, we could see the prices $90 to $100 a barrel. But I don't think we're going to see it above 100. Because when the market is short, there are OPEC plus countries can produce more oil and soften the blow. And there'll be pressure from the US for the blow to be softened by additional production. So I don't see things escalating out of hand, but it could easily go up another $10, $15 a barrel from where it is.
How much capacity do you think OPEC and its allies have to perhaps boost the supply in the market? Should we see a shutdown and the impact from the closure of the Strait of Hormuz?
I think with the unwinding that OPEC Plus is doing, there would be 4 to 5 million barrels per day spare capacity. You need about 2 million barrels per day spare capacity to stabilize the markets. If you have less than 2 million, then you would have big gyrations on the price. So easily the Iranian oil exports can be replaced.
We know that the attack on Iran was based on the assumption that Iran is close to being able to produce a nuclear weapon. From your own readings, how likely is it being able to put one together within a week, as with the assumptions made by Israel?
I think you have had the competent authorities in the US, the head of the security agency, saying that Iran has not tried to make a bomb in the recent future, maybe in earlier years. So I don't think within a week something is possible. But the issue that I think the Israelis are concerned with is that, is there an intent? When you threaten to destroy Israel, is there an intent to build a bomb or not? And that is what they want to remove. And I think that this time they will not stop the conflict until that threat is removed, either by a regime change or either by totally paralyzing the Iranian system of nuclear facilities and the economy.
Fereidun, given the developments we're seeing in the Middle East right now, what assumptions are you making about oil prices for the rest of the year? Where might it end 2025?
I think that still by the end of the year, the prices would be 60, 65. Maybe by early next year would be lower than 60. We have to look at the fundamentals at the moment remain tight. But by the fourth quarter of this year, the fundamentals will be loose because there will be lots of inventory building. So if this had not happened, the prices would have been 55 to 60 by the end of the year or early next year. And it's up to OPEC Plus to see whether they want to produce or they want to go to market management. Our read in FG is that eventually, sometimes end of 25, early 26, OPEC Plus will go back to market management and try to bring the prices back to the $70 a barrel range. $70 is where God wants the price of oil to be. It's good for everybody. It's good for the sellers. It's good for the buyers. It creates enough supply and it does not kill the demand. So I think eventually that's where the prices will end up.
We're keeping an eye on the energy market also because of ADNOC's $19 billion takeover offer for Santos. That is a 28% premium. What's your take on this deal?
Well, it's a great price. Santos is a great company, and Kevin Gallagher, the head of Santos, is a great leader. So the issue really is that as far as XRG is concerned, this is one of the global investments that they want to make. They need to keep in mind that ADNOC is a substantial exporter of LNG, but XRG is a different entity, is a global entity which wants to create a lot of LNG and upstream capability inside of the company. My only question would be that whether the Australian Foreign Investment Review Board would accept this or not. And I think it would be challenging for them to approve it. In the past, they have been very reluctant to make these rules. But this is a great premium and it's a good deal.
What might make the Australian government approve such a deal?
I think if the Australian government is assured that maybe the management of Santos will continue, that Santos will remain an independent player, that Santos, which I think is very much possible for XRG to agree with, because they don't want to run everything personally. They would like the existing system to continue to function. I think if you can convince them that this will function as an Australian company with foreign ownership, they might go along with it.
So what needs to be done right now if they want this deal to go through?
I think discussion needs to be held between Kevin Gallagher and the Australian government and XRG. And the Australian government needs to become convinced that this is not giving up national security, but this is strengthening national security. And I think that it's possible to make that conviction. There is a strong case to be made.
Fereidun, thank you so much for your perspective today. Fereidun Fesharaki, Chairman Emeritus at FGE. Now, still ahead this hour, BNY talks to us about their Middle East strategy as the conflict between Israel and Iran looms over the outlook. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Here are some stories we're following. The Associated Press says a man is in custody suspected of killing Minnesota Democratic State lawmaker Melissa Hartman and her husband, Mark. Two other people were also wounded in Saturday's shootings. The FBI had been offering $50,000 reward for information leading to the arrest of a suspect named as 57-year-old Vance L. Bolter. Authorities search a vehicle linked to Bolter as they seek possible motives. The Washington Post is reporting that the U.S. is considering restricting entry to citizens of an additional 36 countries. An internal memo covers 25 African nations, including key U.S. partners Egypt and Djibouti, plus countries in the Caribbean, Central Asia, and several Pacific Island nations. The move would mark a significant expansion of the travel ban announced by the Trump administration early this month. And California is urging a federal appeals court to maintain a lower court's order limiting the Trump administration's use of National Guard troops in Los Angeles. Lawyers for California argue that allowing the administration to continue directing troops in the city would escalate tensions and increase the risk of violence. The legal fight follows days of unrest amid protests against President Trump's immigration raids. And still to come, the head of BNY's international unit joins us with insights on the market impact as the conflict between Israel and Iran shows no sign of de-escalation. Keep it here with us. This is Bloomberg.
They cannot afford to surrender without a fight. Otherwise, the regime is at risk. But Israel can afford to go on much longer.
Iran needs to just decide between no nuclear enrichment and massive FDI, and then a civilian nuclear program potentially that would support growth in a post-oil economy.
It'll be interesting to see if their leadership continues to be targeted, if they change their mind and they do ask for a ceasefire and some negotiations over the nuclear program.
We should keep the pressure on, and our role in that would be not to join in militarily, but to really bring down the ability of the Iranians to export oil.
If Iran's ability to produce and export oil is disrupted, I think China would have to look elsewhere for some of its oil supplies.
Some of our guests today sharing their insights on the conflict between Israel and Iran. The conflict is expected to dominate conversations at the G7 meeting in Canada. Gathering also marks the first big international summit of President Trump's second term. For more on what to expect, let's bring in Bloomberg's John Herskovich. John, how is this G7 shaping up in terms of Trump and the other members?
Well, this is Trump's first big summit since taking office, returning to the White House. And during his first term, he's shown that he's found these meetings kind of tedious. He's had standoffs with other leaders. There have been divisions. And since that time, these divisions have only deepened with Trump's trade wars. The only leader, I think, who's returning from Trump's first term at this summit will be French President Macron. So we have these concerns going in, and some of the expectations have been tampered with. There's probably won't be a joint communique, one of the traditions of this summit. And Iran and Israel is front and center. We have various points of view about how this can be resolved, and this will be one of the points of friction at the summit. Other things will include Ukraine, Russia, which has been going on for several years. And it also remains to be seen how Trump is going to handle this situation. The summit is in a remote part of Alberta to diminish the prospects of protests, and also to give the leaders more time to speak with each other. We have Trump will probably be having his first meeting with Mexico's new president. South Korea's new president, Lee Jae-myung, is going and is hoping for talks with Trump as well. So there are a lot of dynamics going in, but at front and center now is the conflict between Iran and Israel.
John, we know that Trump considers such summits as tedious. He said so himself. What is the U.S. really looking to get from the summit?
Trump, before he left, said that this summit is going to focus on trade. He's trying to do his 90 deals in 90 days. The clock is ticking down, and there's not much on the ledger in terms of actual deals. So this is what the U.S. is looking for. They're looking for energy cooperation, trade deals, and probably getting support for Trump's views on matters such as Israel, Iran, and Ukraine. Whether that will actually be successful remains to be seen. The concerns of the other leaders, I think, are going to be on much broader issues than just the U.S. interest in pursuing bilateral and bloc deals with groups like the EU. So there's a little bit of a conflict going into this about what the U.S. wants to achieve and Trump wants to achieve, and what may be the actual subjects of discussion.
John, thank you so much for that. Bloomberg's John Herskovich. We're now joined exclusively by Hani Kablawi, head of international at BNY, one of the oldest banks in the U.S. Good to have you with us. So,
great to be with you, Haslinda.
Lots of issues on the table at the G7. We have trade tariffs, we have geopolitics, not just Ukraine. Now we have Israel and Iran. Yet when you take a look at the markets, it seems pretty resilient. And it does seem like there's so much complacency. Is that a fair assessment to be making?
I think there is complacency. I think it's interesting, by the way, the G7, Mark Carney, who's chairing the meeting, has left a lot of time for bilateral discussions, acknowledging that there will be a lot to accomplish within the 90 days, and President Trump would want to get a lot of deal-making going while he's there. Look, I think the conflict in the Middle East is something to watch. Interestingly, we had seen a drop in the dollar over the past couple of months, pause over the weekend and into Monday. Obviously, a little bit of a potential safe haven status, a little bit coming back. But you're right, the markets are a little complacent. They had been complacent on the tariff trade, the 90-day détente, and I think they continue to be complacent today. I think the things to watch out for, obviously, from an oil price perspective, is the flow of oil through the strait. 20-25% of the world's oil flows through that strait, and that's an important thing. Obviously, that's a weapon that Iran has threatened but never used before. And obviously bombing of Iranian oil fields, but more seriously, potentially, the bigger escalation of Iran bombing oil fields in the Gulf region. Any one or a combination of these things could take oil prices well beyond the $70, $75 we're seeing today.
The question really is, at what oil price will market sentiment be dented? Some say that if the Strait of Hormuz is shut, we could see 120. That that would impact sentiment in the equity market in particular.
It certainly would. There's no question that 120 oil
But
prices
what's the
would...
tipping point? You talk about, in excess of 70. Would 80 be the point? 90 be the point?
I think it's hard to tell. I think that 70, 75 is already at a high level versus what we've seen previously. A lot of budgets get cut based on what markets get used to over the prior quarter or two. I think 80 to 85 would start impacting sentiment. 120 would be a certain shock factor.
So what do you know? What do you do now with your portfolio? Do you just sit on it till there's greater clarity, or are there opportunities to be had?
I think the opportunity, a few things that we're observing. One is that certainly in the US, corporate earnings are something to watch going into the second quarterly results in July. Those have two factors tugging at them. One is sentiment from the tariffs playing out and catching the data up to it, because the sentiment's been negative, the data's been okay, complacent to your point. And on the other hand, you've got the bill, which is a tax and regulatory relief bill. And it'll be interesting not just to look at the second quarter earnings, but also to hear the sentiment on a go-forward basis of the CEOs and CFOs that are announcing them. I think that's an important one. Secondly, July has a lot of data that comes with it. Data coming from central banks, FOMC towards the end of July is something that we're watching. We think there could be a quarter point cut. Obviously, that's going to be data dependent, but we think the data will come in July that might affect or result in a Fed tightening in the second quarter. And I think the third thing is a home bias and a hedging of US dollar exposures. We've seen that over the past couple of quarters. We think that continues regardless of the conflicts that we're seeing in the Middle East and elsewhere. The US dollar bond is hedged at about 80%. US equities are hedged at about 20%. There's a lot more room to continue to hedge US dollars. And that's on the understanding that global investors don't have too much choice beyond dollars and their home biases to invest in, and therefore they'll look at the currency and see what they can hedge there.
So far, the weakness in the dollar has been driven pretty much by the data out of the US. It does seem like no matter what happens in the Middle East, the weakness in the dollar will likely persist from here.
I think it's interesting, actually. The dollar weakness started a few quarters ago. We saw some movement in sentiment against the dollar as far back as June of last year, again after the election, again in January of this year, and obviously the big one in April. There's been positioning away from the dollar on the margins. I mean, we've had the U.S. dollar exceptionalism trade running for really the past multiple years, 3 years, 4 years. But over the past year, we've seen bouts of kind of selling pressure on U.S. dollars, and I think it's accelerated since April. I don't see much that stops it today. Again, there is a home bias, and I think the tariff story has to play out before we come back and see where the dollar ends up.
Weaker dollar, higher oil isn't great for the Fed, and you'd imagine that it will think twice about what its next moves are. And in relation to that, how do you see central banks in this part of the world reacting?
Yeah, I mean, starting with the Fed, their minutes have all been about waiting and seeing. Our market strategists are anticipating 2-point-some cuts this year, so 2 and then not insignificant potential third. We think the first cut comes potentially at the end of July, so that's probably earlier than the market expects it to. That will be data dependent, but we think that the data will bear this out during the month of July. I think this region, interestingly, has been on a interest rate reduction. The reserves are healthy, ASEAN especially, interest rate reduction trend. And it is interesting that they're doing that because there's a weakness in the US dollars and a stronger reserve position. So we talk about complacency, but the complacency here potentially is actually supported by the data.
Hani, hang tight. Hani Kablawi, head of international at BNY, is sticking around with us. Well, still to come, China's domestic consumption posed a surprise jump, offering a glimmer of hope for economic policymakers. A closer look at the numbers next. Keep it here with us. This is Bloomberg. Welcome back to Insight. China's domestic consumption surprisingly jumped as the economy rode out the tariff roller coaster in May, offering a confidence boost to Beijing. Let's bring in our China correspondent Min Lo in Hong Kong. Min, give us an overview of the economic data out today and why did we see such a big jump in retail sales?
Yes, Has, it was actually quite an uneven picture. We saw a miss in most of the metrics from fixed asset investments to industrial production, but retail sales was the big standout. It was a big blowout to the upside, 6.4% versus consensus estimates of 4.9%. And just to give you context, you look at the range of estimates, the highest range in that range was 5.5%. And even then, the retail sales, the actual number, still beat the highest estimates within the economists' estimates. So it was a big beat there. And one big reason is because of the 618 shopping festival, which typically starts in end May or early June. But this year it started a couple of weeks earlier in middle of May. So that could have contributed to the big jump in retail sales. We saw the same thing last year in October with the Double 11 festival when the discount started about a couple of weeks earlier than usual. But the downside here is that we could see a pullback in June, a payback effect for the early discount season. So that's something to keep an eye out for, because if you look at the broader data, especially if you look outside beyond the sectors that are supported by the consumption subsidies, the equipment upgrading program, overall consumption outlook still looking pretty downbeat, especially if you take away all of these discount festivals. So that's the long-term trend to keep an eye out for. And you look at industrial production, 5.8% is the actual number in May, a miss of the estimates and also down from the previous month. No surprise here given the exports decline to the US after those tariffs kicked in. And of course, we also have home sales, home prices down 0.2%, that decline accelerating over the past couple of months. Also not a good sign for the recovery in the housing sector.
Min, thank you so much for that. Bloomberg's China correspondent Min Lo. We're back with Hani Kablawi from BNY. So when it comes to China, I mean, even though the data is mixed today, overall, in terms of fundamentals, still not strong.
So, and April was particularly weak, but since then we've seen the stimulus programs come out of the government, including the interest rate reductions, the reverse repo reductions, and money really being pumped into the economy. We think that that'll, that will account for a little bit of a bounce back in demand that goes on top of what Min has just said. So presumably China demand activity, so the supply side has really come to bear again this year after an earlier in the year stimulus program, and I think potentially that drags demand with it.
If you take a longer term perspective, would you be a buyer of Chinese equities, for instance? I mean, we've seen how, Chinese stocks in Hong Kong are actually in bull territory.
They are in bull territory. And look, EVs, AI, the technology sector has performed particularly well. Traditional sectors in China over the past 6 months, less well. So that's the demand side that needs to be dragged along. I'd watch for a few things. I think that the tariff negotiations, look, China's used to tariffs of 18 to 20%, another 10% on top of that. Consumers can potentially absorb. So it depends on the outcomes of these negotiations and the détente that we're in. What happens by August, September of this year? We'd watch that pretty closely. And then the other thing we'd watch is the technology sector. We saw that Taiwan restricted imports of certain chips into Huawei and other Chinese companies. So, to what extent does China continue to have access and an ability to produce technology that is market leading?
So innovation is one area where China could do well. Some say healthcare.
And healthcare. So EV, AI, healthcare are all areas that I think China has a bit of a at least regional advantage in. But these are things that play out on a global scale as well.
The other market that investors seem to be really excited about is Japan.
Yep.
Some see a lot of opportunities in the Japanese market. What do you see?
Yeah, so a couple of things. At a macro level, the monetary policy in Japan is interesting to us. I think Japan might have already hiked rates had it not been for the tariff uncertainty environment that we are in. So tariffs playing out and Japan's role in the bilateral negotiations and how they come out are going to be very important. And I think then, Japan reducing their buyback program is a potential watch item. Buying back at 400 billion, potentially reducing to 200 to 300 is another watch item for us. But Japan's savings and investments, or savings into investments drive, is a long-term positive for the country, and we think it's an opportunity for companies like ours and others.
You talked about how the BOJ would have raised rates if not for the tariffs. When do you see the BOJ making its moves? Because the market's still divided when that move might come.
Yeah, it's going to be data dependent and presumably tariff sentiment dependent as well. So it's very difficult to call it right now.
When you take a look at the region, we talk about how people are pulling back from U.S. assets and putting their money in this part of the world. On balance, how is it looking for Asia?
So we service $53 trillion worth of assets under custody and administration. We've got our big data models that aggregate and anonymize. And a lot of the trends that we've seen, certainly since earlier this year, let's call it January, February, are an end to the U.S. exceptionalism trade and money coming back home. And so Asia has certainly seen money come back home that had been invested previously abroad. And then money in the region moving around within the region. So we do see a lot of money going into China through the corridors, out of China as well, southbound through the Connect programs. Korea has been on the receiving end this month, especially of a net $3 billion, equivalent of $3 billion after the political kind of issues were resolved there. Taiwan's been interesting, obviously the semiconductor and chips manufacturing story there. There's a lot of money that's coming into the region. ASEAN, I mean, if you look at Indonesia's probably been, the rupiah, probably the most consistently held currency over the past 3 years. And that's because of a government industrial policy, a long-term vision. The nickel story is very strong there. And I think the ASEAN region broadly benefits from a reduction of tensions around the China tariff, US tariff story as well.
You've mentioned a lot of Asian economies, but you've yet to talk about India. Are you not liking India? People say it's time to be bullish India.
We like India. We observe the cross-border flows into India. Those remain, for capital control reasons, limited. But within India, there is a very interesting story of getting wealth assets turned from savings into investments. And we think there's a lot of upside in that over time.
You know, what's also interesting is the Middle Eastern market. I mean, you're going deeper into Saudi Arabia, for instance, and we're seeing a lot of money moving towards the Middle East. Where are the biggest opportunities there?
It's interesting, actually. The Middle East is also a story of home bias. It's Middle Eastern money that is coming back home, as opposed to foreign money that is being invested in the region. There's a lot of corridors that are being established. There's a lot of interest in the Middle East, and I would say similar to Asia, actually, there's a lot of interest in the ASEAN region, money sitting on the sidelines looking for opportunity. It's the same thing in the Middle East. Right now, it's a lot of Middle Eastern money coming back home from the US and Europe to be invested in these mega and giga projects that have been announced. And it is the right way to do it, because if you want foreign direct investment to come, you've got to put your own money behind the big risky programs and build the business cases for them. And that's a lot of what we're seeing in the Middle East right now.
Well, isn't the Middle East also benefiting from the US-China tensions and disruptions in supply chains?
I think the Middle East, it's interesting. What the Middle East is doing is saying we don't have to be dependent or reliant on any one party. We're going to build strong relationships with the US. We're going to build strong relationships and supply chains with China and with Asia and elsewhere around the world, and just move from a bilateral to a multilateral geopolitical and economic model, a more resilient, more diverse supply chain model.
Before we let you go, just one final question. What's a must-have for 2025 in terms of
AI investment? Those who are late to the AI investment opportunity will find themselves increasingly behind the curve, and it's AI or die.
And where is the best opportunity to get exposure to AI?
Well, so it's exposure, but it's also for companies to invest in AI to make sure that they are on the cutting edge of efficiency, product innovation, and potentially even business model transformation.
Hani, thank you so much for your time today. Hani Kablawi, Head of International at BNY. Well, we're keeping a watch on Tencent in particular. The Chinese tech giant Tencent is neither considering nor pursuing an acquisition of South Korean video game developer Nexon. Let's take a look at how we're seeing in terms of the market reaction there. Tencent currently down 0.8%. Nexon slumping almost 8% as we speak. Tencent not considering Nexon acquisition. That's according to the information at this point in time. We're also keeping an eye on where oil prices are right now on the back of the escalation that we're seeing in the Middle East. We're seeing fresh wave of attacks from Iran. Brent crude currently up by 0.8%. New York crude also higher by about 1% right now. 73.65 is what we're looking at this point in time. Now, before we go, here's a look at tomorrow's show. We'll get fresh market insights from Morgan Stanley Investment Management's Andrew Sliman. That's as we keep an eye on further developments in the Middle East and await the latest rate decision from Japan. That is it from Insight Horizons Middle East and Africa. It's next. Keep it here with us. This is Bloomberg.